If you get this decision wrong, it does not cost you a year. It costs you decades. In Australia, the property versus ETFs debate is almost tribal. One side swears by bricks and mortar. The other side believes low-cost index funds are the superior path. Both claim long-term wealth. Both point to data. Both sound convincing. But here is the uncomfortable truth. Most Australians choose based on emotion, not mathematics. Property feels real. You can see it. You can touch it. You can drive past it. ETFs are numbers on a screen. And yet, historically, the Australian share market, including dividends, has returned around 9 to 10% per year over long periods. Australian residential property, nationally, has averaged closer to 6 to 7% per year in capital growth. That difference might sound small, but over 30 years, a 3% annual return gap can mean hundreds of thousands of dollars, sometimes more than $1 million, depending on contributions and compounding. So the real question is not which one sounds safer. The real question is, when you factor in leverage, tax, cash flow, risk, and behavior in Australia, which one actually builds more sustainable wealth? Let us break it down properly. Here is why property often wins the argument immediately. Leverage. In Australia, banks will lend you 80%, sometimes more, of a property's value. You might buy an $800,000 investment property with a $160,000 deposit and a $640,000 loan. Now imagine that property grows at 6% in 1 year. That is $48,000 in capital growth. On your $160,000 deposit, that is a 30% return before costs. That is powerful. This is why property investors can accelerate wealth faster than unleveraged ETF investors. They are not necessarily earning higher growth. They are amplifying growth using debt. But leverage is not free performance. It is amplified exposure. If that same $800,000 property falls 10% during a downturn, it drops $80,000. Your $160,000 deposit just absorbed half its value. In 2022, when interest rates in Australia rose sharply, national dwelling values fell more than 7% from peak to trough. Highly leveraged investors felt that pain immediately, while still servicing rising mortgage repayments. With ETFs, most investors are unleveraged. If your $160,000 ETF portfolio falls 10%, you lose $16,000. Painful, yes, but there is no bank demanding repayments. Leverage accelerates gains, but it also accelerates stress. And stress changes investor behavior. That matters more than most people think. Now let us talk about something that quietly builds wealth in the background. Total return. The ASX 200, including dividends reinvested, has historically delivered around 9 to 10% annually over long periods. A significant portion of that comes from dividends, often yielding 3 to 4% per year. Those dividends can come with franking credits, which reduce tax for many Australian investors. When dividends are reinvested, compounding accelerates. Here is a simple example. If you invest $100,000 into a diversified ETF earning 9% annually and leave it untouched for 30 years, it grows to roughly $1.3 million. At 6%, the same $100,000 grows to around $574,000. That difference is not small. Property growth is typically measured as capital growth only. Rental yield is separate, and net rental income is often reduced by expenses, especially in negatively geared properties. Here is the counterintuitive truth. Unleveraged, shares have historically outperformed Australian residential property. Property feels powerful because of leverage. Shares feel boring because they compound quietly. But boring compounding over decades can be extraordinarily powerful. Here is something many new investors do not calculate properly. Cash flow pressure. In many Australian capital cities, gross rental yields on houses sit between 2.5 and 4%. Meanwhile, mortgage rates in recent years have often been higher than that. That means many investment properties are negatively geared. The rent does not fully cover interest, rates, insurance, maintenance, and property management. The investor covers the shortfall from their salary. Yes, negative gearing allows you to deduct those losses against your taxable income. Yes, you may receive a tax refund, but you are still spending real money each month. Now compare that to ETFs. A diversified ASX ETF may yield around 3 to 4% in dividends. There are no maintenance costs, no emergency repairs, no strata surprises. Income arrives automatically. You can reinvest it automatically. The difference is not just financial, it is psychological. Cash flow stress can force property investors to sell during difficult periods. Stable, low-maintenance income from ETFs can make it easier to stay invested. And staying invested is where wealth is built. Now let us address one of the biggest reasons property dominates in Australia. Tax policy. Property investors benefit from negative gearing, the 50% capital gains tax discount after holding an asset for more than 12 months, and depreciation deductions on certain properties. Those incentives are powerful. But ETFs also benefit from the 50% capital gains tax discount after 12 months. Australian shares often distribute franking credits, which can reduce or even eliminate tax for some investors, depending on their income bracket. Here is a surprising fact. Franking credits can significantly increase after-tax returns for Australian investors compared to unfranked income. The tax system does not exclusively favour property. It rewards long-term investing. The real advantage in property is the ability to deduct interest expenses if the property is negatively geared. But again, that benefit only exists because you are borrowing. Tax reduces friction. It does not eliminate risk. And it does not replace poor fundamentals. Here is a question most investors never ask. How quickly can you access your money? If you own ETFs and need $20,000, you can sell that amount tomorrow during ASX trading hours. If your wealth is tied up in a single $800,000 investment property, you cannot sell the bathroom to raise cash. You must refinance or sell the entire asset. Property transactions in Australia involve stamp duty when buying, often tens of thousands of dollars, and agent commissions when selling, commonly around 2% or more. ETFs have brokerage fees that may be under $20 per trade and management fees often below 0.20% per year for broad index funds. Accessibility is also different. You can start investing in ETFs with a few $1,000s. To buy property, you may need a deposit of $100,000 or more, plus stamp duty and other upfront costs. There is also concentration risk. One investment property exposes you to one suburb, one local economy, and one tenant market. A diversified ETF can provide exposure to hundreds or thousands of companies across Australia and globally. If one company fails, the impact is minimal. If one suburb stagnates for 10 years, your property growth may stall entirely. Property risk feels lower because prices are not updated daily. But slow-moving prices do not mean lower risk. They just mean slower visibility. So which one wins? The honest answer is this. Both can build substantial wealth in Australia. Both can fail if misused. Property can accelerate wealth dramatically when leverage is used wisely and held over long periods. ETFs can build wealth steadily through diversification, low costs, and relentless compounding. The real deciding factor is not the asset. It is the investor. Can you tolerate debt? Can you survive rising interest rates? Can you hold through market crashes? Can you stay disciplined when headlines are screaming fear? In 2008 and again in 2020, share markets fell sharply and then recovered. Property markets have also experienced downturns and long stagnation periods. The investor who consistently contributes, manages risk, controls costs, and avoids emotional decisions is the one who wins. Here is the final myth to break. There is no single correct path. The real mistake is doing nothing while debating which asset is superior. Time is the true engine of wealth. Whether through property or ETFs, the earlier you start and the longer you remain disciplined, the greater your outcome. Property versus ETFs is not a war. It is a strategic choice. Understand the mechanics. Understand yourself. Then choose deliberately. And once you choose, commit long-term. Because in Australia, wealth is rarely built in a year. It is built in decades. If you found this explanation valuable, subscribe to the channel. New videos break down Australian finance, wealth, and the systems quietly shaping your future. Like the video so more Australians can discover this, and leave a comment with what you want explained next. Your support genuinely helps the channel grow.